Hello friends and welcome back to the channel. Now it is no secret that we are in pretty choppy market conditions at the moment with our year-to-date figures on the stock market looking pretty bleak, not to mention all of those crypto hunks over there that are suffering probably the most Baltic winter for a long time, suffering upward of 90% losses on their stuff. But the biggest question that has been floating around is, are we in or are we going into a recession? And more so on that, who on earth tells us when we are? So in this video, I'm going to be breaking down all of the stats that I've researched for you and trying to make sense of them all so we can better make a decision and know how to manage our expectations for the coming few months. Now, whilst the global recession is fairly likely, I'm going to be focused on the US for this one because it is probably the most prominent nation for the financial markets. And for those of you that follow me and have followed me for a while, know that I tend to exclusively trade the US 30 or the Dow, which of course tracks the US economy and the S&P almost perfectly. For those of you that are new around here, my name is Matt and I cover all things day trading and personal finance, so if that is your vibe, then click subscribe. Okay, that's enough of that. So let's move on and get into the video. So we are going to explore A, how do we know that we're in a recession? B, who actually tells us that we're in a recession? C, when we'll find out, and that is pretty close. And D, how things are looking currently and what we can really expect in the coming month or two. Okay, so first and foremost, what is a recession? Well, economically speaking, it's where there's been economic shrinking, as it were, for 2 consecutive quarters. Now, this is measured by GDP or gross domestic product, and for the most simple definition, that essentially just means the total value of all the stuff that a country produces from goods and services. Now, of course, GDP is looked at on an annual scale, but it is also broken down into quarterly readings, which the US report on. So essentially, this just means that there are 4 blocks of 3 months for a calendar year that the BODs will be reporting on to keep a good track on the economy. So where is the best source for us to find out what the GDP readings are, and how do we know if we're likely to go into a recession? Well, unfortunately, the cats over at the BEA, or Bureau of Economic Analysis, do produce these reports on a 3-tier system. Now, the reason there are 3 is just due to the sheer complexity of all of the figures and the data that they are trying to put together. So generally speaking, the first one is where the huge amount of the work goes into, but the second and the third kind of tighten up those figures to be more accurate as all of the data keeps filtering in throughout that period. Now, the first one that a lot of people pay attention to that we referred to there is called the advanced estimate. And the reason why people listen to this the most is because that is ultimately the one that everybody is waiting for. This is the first indication, once a quarter is finished, of how that quarter has gone from an economic perspective. And whilst the figures may move after that fact when they refine the data, it's unlikely to show any drastic changes beyond that point. So all in all, yes, there are 2 further releases, and yes, that does adjust the figure, usually marginally, but this is just due to the reason that not all data can come in at once. So generally speaking, the advanced estimate, or the first one, is generally robust enough to take a hell of a lot of confidence in terms of what that figure and final figure will be for the quarter. So when do we get this advanced estimate? Well, typically this happens 4 weeks after the quarter ends. So for Q1 of this year, January to March, the advanced estimate came out on April the 29th. And in this report, it said that the GDP was negative 1.4%. And this was significant for 2 big reasons. Number one, well, it marked the first shrinking quarter of a possible 2 to declare a recession. And this, of course, sparked off a lot of fear and panic and resulted in a lot of immediate sell-offs. Number 2 was the entire perspective and context of the data, as this figure was coming off the back of Q4, which had been reported at positive plus 6.9%, which so happened to be the largest increase or expansion of the last 18 months. Now, the only comparable drop in the last 18 months was actually in Q3 of 2021. And this is where it went from a growth stat of 6.5% in Q2 to then reducing to a growth stat of just 2% in Q3. But of course, the most important part of this was the fact that it still remained positive and that the GDP was still expanding. Even though it was a significant drop in terms of relative expansion, it was still very much in the positive and still pointing in the upward directory for the economy. Now, the negative 1.4% figure that we had received for Q1 of this year that has put the world into a little bit of panic, that was actually the advanced estimate. And since the second estimate came out, they then revised this and it actually turned out to be negative 1.6%. And on top of that, we will be receiving the third and final report of Q1 on June the 29th, just next week, to see what the full picture was and the final stat and the negative figure. But of course, being negative in Q1 does not mean that we are in a recession, it just means that we're halfway there. And that third estimate that will come through next week won't determine if we are or if we aren't, it will just give you the most accurate figure for how Q1 ended. So the big question marks and why this is such a hot topic at the moment is because we are just nearing the very end of Q2, which means this is the judgment quarter. So if the advanced report for Q2 shows anything negative, then we'll officially be in a recession in the UK. Scary times, right? But when will we find out? Well, if we look at the schedule, we'll be finding this out on July 29th next month. So with this in mind, how are things currently looking for Q2 and what can we realistically expect from that announcement? Now, there are a lot of tools out there and a lot of people that are predicting certain things based usually on their own agenda, sue me, but trying to find ones that actually match up with the final results historically, I came across the Antlantafed GDP Now tool. Now, essentially the way that they predict the results is very similar to the process that the BEA or the Bureau of Economic Analysis use to actually produce their statistics. And when you look historically, there is a high correlation between the predictions and what the final results were from the BEA. Now, the stats that are being produced by the cats over at Antlantafed are updated frequently as we go through the quarter to try and bring much more of an accurate estimate before we get the official figure from BEA. So I guess now the biggest question is, what is the current prediction from the Antlantafed in terms of what they believe the GDP reading will be for the end of Q2? Well, it has been revised a few times in a few weeks, which is a bit of an alarming sign, and is even more alarming when you look at the direction that it's gone. Well, in recent weeks, the highest prediction was set at 1.9% growth, which then was quickly revised almost a week later down to 1.3% growth. Then, more or less a week after that, they revised that prediction again to 0.9%. But yes, I know what you're thinking, 0.9% isn't great, but it still means we're in the positive, and it means that we aren't going to be going into a recession, and therefore the doomsday impact isn't going to happen. Well, nah. At the time of recording this video, they have just released their latest prediction, and that has predicted 0% as the figure. Okay, so twitchy bum time for sure, but 0 doesn't mean negative, and therefore that means that we won't go into a recession and everything is gonna be alright. Wrong. As with any sort of this large-scale analysis, there is always going to be sort of a margin for error. And the Antlantafed are very upfront about this, God bless them, that their margin for error is around 0.84%. So yes, theoretically, this 0 prediction could actually be growth of 0.84%. Woohoo! But in reality, and taking into account the trajectory of the predictions so far, it could end up as low as negative 0.84%. And as we've discussed, anything less than 0 will officially put the US in a recession, and the poo will hit the proverbial fan. Now, of course, this is just one pretty accurate source, and there is always a wide spectrum of opinions and predictions out there. But all that aside, I just think it's fairly worrying to see the trajectory of an institution that has been historically very good at tracking what the results actually are, and the fact that they started fairly optimistic, and as we're getting towards the end of the quarter, they're going down, down, down again. And to add fuel to that fire, of course, in the recent week, King Powell has increased the Fed rates to try and mitigate against the ridiculous amount of inflation that they're suffering at the moment. Of course, this is just an attempt at deterring borrowing by increasing cost and therefore lowering the chance of eligibility, and then lowering the amount of money that A, is being spent by the average Joe or Jolene, and the available money to be spent by Joe and Jolene will be slashed, and therefore causing a fall in inflation and cost of stuff in general. Now, whilst inflation and recession aren't the same thing, despite what a lot of people do think, consumer spending does actually account for around 70% of that GDP figure. So by putting these two things together with the hiked rate increases by King Powell to cause less consumer and corporate spending, this could likely have a firm sway on the final GDP figure that is 70% comprised upon consumer spending. Make sense? Good. So yeah, I hear you, that's all well and good, but what can we expect and what does this all really mean? Well, here are the key components to consider to form that decision. There's one negative quarter already. The second has had multiple downward facing predictions, now sitting at 0% with a margin for error of 0.84%. The Fed have increased rates to reduce consumer spending, which will impact at least 70% of the GDP figure. And the obvious one is that everybody is talking about a recession, and therefore people are becoming more conservative by nature and trying to store more cash and spend a little less just in case. Now, if we're being honest, all the signs are kind of pointing towards an Armageddon few months where both businesses and consumers are going to be feeling the pinch. And well, what does that mean for the markets? Well, we're currently in a bear market as things stand, and should there be a negative figure showing a shrinking economy for 2 consecutive quarters released on July the 29th next month, then I'm pretty sure we're going to see more of the same. And if not, even bigger enhanced reactions. Conventionally in these moments, the masses tend to sell off lots of their investments in panic at the time to try and ride them through these down patches, to make way for more cash and to not lose any more money. And this will of course have a huge rush across all of the financial markets and housing markets within the US initially. However, if we don't get a negative report on July the 29th, which is what a lot of boards and institutions are actually alluding to, whether they've got an invested interest in that or not is up for debate, then of course we could see an increased drive and spike up in the market, registering some short-term consumer confidence. Though, given all those factors, the latter does seem more unlikely, and also the upward drive may only still be temporary. However, as with anything with the world markets, who knows? Because I don't. But with all that being said, what are your thoughts on the upcoming announcement on July the 29th? Do you think that the US is going to be registered into a recession next month or not? I'd love to hear your comments and your justifications in the comment section below. If you have enjoyed this video at any point or found it even partially interesting, but especially if you haven't, then please hit that likes up button. It goes a huge way to supporting me as a creator and letting YouTube know to keep me out of my cage for a little bit longer. But if I don't speak to you before, have a cracking rest of your day and I'll catch you in the next video. Take it easy.